With a war on the Eurozone's border, an uncertain energy supply from Russia, and a growing risk of recession, the pressures bearing down on the euro have grown so strong that this week the currency dipped below the US dollar. And this hadn't happened in 20 years, since the early years of the euro's existence. But what does this mean for investors? First of all, some would say, and especially American tourists or anyone earning in dollars, it's a boon for their holidays.
Things are a little bit more affordable for us, so we can do some things that we might not have otherwise done. So the cost of the trip was less expensive, hotel was a little less expensive, food is a little less expensive, and we can do some things that are luxuries that we enjoy.
The parity with the dollar is also advantageous for this French merchandiser who went to the US last year for work but came back to Europe in October. He says without realizing it at first, he's found the perfect timing for his business trip.
I'm realizing that, yes, I'm happy to have left in October because it allowed me to have a bigger budget for entertainment and bringing things back from the United States. If I were to leave today, my budget would be eaten up by my daily spending, to eat, for accommodation, and so on.
And a low euro is a bonus for European exporters too. Here's why.
The strong dollar means also export opportunities for everybody else. And that should help us in a couple of years to compensate for the higher oil prices. The euro area has always adjusted in this sense. First, we have to pay for higher oil and gas. Our external accounts go into deficit. But after a while, our exports increase, and then also we get more jobs, and therefore the adjustment can be done.
But as with many things in finance, there is always the other side of the coin, and this side is far less encouraging. First of all, a higher dollar is making oil and gas and all commodities more expensive as they are all dollar denominated. And this comes at a time when oil prices are already hovering around the highest levels in 8 years, making the job of policymakers now trying to weather an inflation running at 40-year highs in Europe much harder. According to Daniel Gross, if the ECB doesn't act quickly, the pressure on prices will worsen, which in turn will push the euro even lower.
The ECB has been slow, and it has certainly been behind the curve. And now it has, rhetorically at least, said we will change and we will combat inflation. But it says that it will do so in a very, very gradual way. So the fear is that it might actually fall further behind the curve. But it certainly has recognized the danger, and I think it will have to accelerate when it sees that inflation is serious and is here to stay for a while.